This video is on financial ratios, in particular profit ratios, including the gross profit ratio and the net profit ratio. Now, primarily, these ratios are a management tool for judging the financial performance of a business. They can assess whether that performance has improved, whether in comparison to a previous financial year, or even it can compare financial performance against competitors in the same industry. They compare actual figures with projected or budgeted figures, which helps to aid in decision making when businesses are forecasting for future times to come. Before we look at the ratios themselves, we actually need to get an understanding of what profit is in general so that we can understand what we're actually measuring. So profit is what we're left over with when we calculate the total sales or income made by a business, and we'll just write income here because income can come in many forms, but today we're just going to talk in terms of sales, and we take away some of the costs of a business. What we're left with is actually the profit of that company overall. Now, it's important for us to differentiate between some of the different costs that are associated with running a business. One of the terms we'll have to become accustomed with is cost of sales. Cost of sales. Now, cost of sales refers to the cost required to manufacture, purchase, essentially to produce a product that is then sold to a customer. And this is really in relation to gross profit, because when we measure gross profit, all we're doing is we're taking total sales revenue and then minusing the cost of those sales. We can also include other operating costs. Now, these operating costs are sometimes referred to as overheads. They can include things like rent, utilities, utilities, or other associated costs like office supplies or even legal costs. Now, these costs are going to be included for net profit, and this is sometimes called net income as well. But the terms we'll use in our video today are gross profit and net profit. When we're looking at the ratios themselves, the term ratio just means, maybe proportion of or, comparison to. So we're actually measuring gross profit, which is sales minus cost of sales, as a percentage of net sales. So it really is, percentage of net sales. And then the profit ratio is all operating expenses, and we can see the little equation here. So we take the gross profit and we minus other expenses as well. This, net profit figure is actually going to be lower than what the gross profit figure is. So, net profit really will always be lower than gross profit because it takes into account all operating expenses of a company, not just cost of sales. So in order to illustrate the importance and function of profit ratios, we're going to look at the financial data of two companies that are in competition, Fremantle Press and Claremont Press. Both these companies are small publishing companies, and we want to try and determine which company is more successful by looking at their profit. So initially, we can see the profit data from these two companies clearly. Claremont Press has actually been able to make more profit, both in gross terms and in net terms. Let's get a different color here. But we can't really make an accurate statement about the profitabilities of these companies yet. Is Claremont Press more successful than Fremantle Press? Are the managers of Fremantle Press less effective? Would they make good investments for future shareholders? Indeed, if you were an investor, which company would you want to invest in? The answer to all these questions is the same thing. We can't actually tell from the information given. The only correct statement that can be made is that one company has made a profit 10 times greater than the other, certainly in terms of the net figures there. We can get a clearer picture by comparing the company's sales revenue to their overall profits. Here again, we can see that Claremont has made more revenue from sales. However, this doesn't tell us much more until we actually compare the sales revenue to the final profits earned. So what we can do is we can look at the proportion of profit made for every $1 of sales earned. In other words, by converting the data into a ratio. And it's very simple what we're going to do. In terms of gross profit, we're going to actually take, our overall gross profits. Let's look at, for example, here, Claremont Press. Our gross profit is $800,000, but I'll just keep it simplified here as 800. And we're going to divide that by our sales revenue, which was $3.2 million, but I'll keep this nice and simplified figure here. By converting this information, we're actually going to find the overall gross profit ratio for Claremont Press, and that figure is 0.25 or 1/4. So what this actually means is that for every dollar that was earned, 25 cents of that was profit. So we can express that as a ratio, saying if 25 cents of profit was earned for every $1 made in sales revenue. So let's have a look at a comparison for the gross profit ratios of these two different companies. So we've gone ahead and we've gone away and we've done our calculations. We can see that the gross profit margin for Fremantle Press was actually 0.5 or a half. That means that for every dollar earned in revenue, 50 cents of that revenue was converted into profit. If we look at Claremont Press, like we have already established, we know that their gross profit ratio was 0.25 to 1, or in other words, 25 cents of profit was made for every $1 of sales generated. Now remember, gross profit is only total sales minus cost of sales. So it doesn't take into account total operational costs. Gross profit helps investors to determine how much profit a company earns from the production and sale of its goods and services, rather than how effectively a company has been managed, which will actually derive from net profit in a moment. So we can see that Fremantle Press actually has a higher profit ratio, even though it earned less profit overall. That means for every $1 of sales revenue earned, 50 cents is converted into gross profit, compared to Claremont Press, which only earns 25 cents of profit per dollar of sales. So Fremantle Press is actually more effective at earning profit from the production and sale of its goods and services. The important note to make here is that when we're talking about profit ratios, and this includes gross profit ratio, the higher the number or the ratio, the better. So the more successful at generating profit from total sales. We can take a look now at the net profit ratio, which, if we remember, net profit actually takes into account, all operating expenses, all overheads which might come as part of running a business. We can see the ratios are lower immediately, and that's because obviously we've added the operating costs to the cost of sales, which means that our profit numbers are significantly lower. Net profit really helps investors determine a company's overall profitability, which reflects on how effectively a company has been managed. So if we compare Fremantle Press's data, we can see that their gross profit margin was actually 0.5 to 1, which was gross profit. That ratio has declined to 0.2, so 20 cents per dollar, once we've taken into account all overheads of the business. When we have a look at Claremont Press, we can see where previously, they were making 25 cents of profit for every dollar of sales, they're now only generating 16 cents for every dollar of sales earned. When we're looking at this new data, what we can determine is that the profitability gap between these two businesses has narrowed, whereas the difference in gross profit margins was quite substantial. Indeed, it was double in terms of how much more profitable Fremantle Press was compared to Claremont Press. The net profit margins are much more alike. This suggests that Fremantle might have relatively high overhead costs when compared to Claremont Press, and Claremont might be really effective at reducing their operating costs. As with all ratios, a comparison of results with those of previous years would indicate whether the performance and profitability of a company were improving or worsening. The net profit margin and the trend in this ratio over time is a really good indicator of management effectiveness and at converting sales revenue into net profits. So in conclusion, profit ratios show how much profit is made by a company when compared to sales revenue. For both the gross profit and the net profit ratio, a higher number means a company is more successful at generating profit, and the difference between the two ratios is the costs involved in determining profit, cost of sales for gross profit, and total operating expenses for net profit.